Press the bell icon on the YouTube app and never miss another update.
Yeah, let's continue with our discussion on capital markets. See, stock markets worldwide will be tracked by their index. In India, we know the two popular stock exchanges. They are Bombay Stock Exchange and National Stock Exchange. I will track Bombay Stock Exchange and National Stock Exchange by tracking their benchmark index. Okay, so we have something called as the benchmark index. When it comes to the Bombay Stock Exchange, the benchmark index is popularly referred as the SENSEX. And when it comes to NSE, we popularly refer that as NIFTY. See, there are thousands of companies listed on Bombay Stock Exchange and National Stock Exchange. I cannot track all the companies. So a certain segment of the companies are tracked, and that is what becomes a part of the index. Bombay Stock Exchange, National Stock Exchange, they have multiple index. I am discussing the benchmark index. Benchmark index means the main index which is normally tracked. So when it comes to the Bombay Stock Exchange, it is known as sensitive index, right? It is from this word sensitive index that we have coined the word SENSEX. When it comes to NIFTY, it is actually NSE 50, right? We call it as National Stock Exchange NSE 50. But just try one day. NSE 50, NSE 50, NSE 50. You try to speak NSE 50 as quickly as possible, continuously. NSE 50, NSE 50, NSE 50. Maybe a time will come when you will start saying NIFTY, NIFTY, NIFTY. So it's more popularly known as the NIFTY. SENSEX, yes, let's discuss further. It has 30 companies in it. 30 stocks, 30 scripts, we may say, are comprised in it. NSE 50, of course, it's very obvious. 50 companies are considered over here. So 30 best companies of India, they are included in the SENSEX. 50 best companies of India, they are included in the NIFTY. This is how I'm tracking the entire economy. See, we will divide the economy into different sectors. So you have a paint sector, you have a cement sector, banking sector, pharma sector, information technology sector, right? And there are a lot many other sectors which are possible. So I will divide the economy into different sectors. Then in each sector, which are the best companies? I will select the best companies, and those 30 best companies representing different sectors of the economy become the part of the SENSEX. Similarly, that same exercise will be done even on the National Stock Exchange. But yes, it is slightly broad-based compared to the SENSEX. Instead of 30 companies, we go for 50 companies over here. So if you are asking me, let's say, if someone is asking you, let's say, that which are the best companies of India, perhaps the best companies of India are those companies which are finding its place in the SENSEX or in the NIFTY. Right. So it is Bombay Stock Exchange, National Stock Exchange, in consultation with its management, in consultation with different credit rating agencies, will decide the best companies of India which are representing different sectors of the economy. That is the reason we call the index as the barometer of the economy. If the SENSEX is going up or if the NIFTY is going up, continuously they are rising, it just means that the economy is expected to do well in future. If the SENSEX is continuously going down, if the NIFTY is constantly going down, it is an indication that we are expecting economy not to perform that well in future. I'm continuously using the word future because demand and supply on the share market will be dependent upon what are the future prospects, right? So the future prospects will decide whether the markets are going up or down. Now, BSE, NSE are not having just only these indices. It's not only the SENSEX, it's not only the NIFTY. These are the benchmark index. Benchmark index means these are the indexes that we will be tracking. But apart from that, there are different possibilities of different types of index which are possible. These were benchmark index, right? You can also have a sectorial index. Yes, this is also possible. For example, you can have a banking index. In a bank index, only banking companies will be included. I can have a pharma index. Well, only pharma companies will be included, right? You can have an IT index, information technology, where only the IT companies will be included. So on one hand, we have a benchmark index, which is the main index. But apart from that, you can even have sectorial index, right? Similarly, you can even have index which are based on market capitalization. Yes, you can have a large cap index, small cap index, mid cap index. That is also possible. Similarly, you can also have what we will refer as broad-based index. See, in Sensex, we are arguing that only 30 companies of India will represent the entire economy. For a country as huge as India, only 30 companies seems to be a very small representation. So I can have something like BSE 100 or NSE 100, where I will include 100 companies of India. The moment I include 100 companies of India, it becomes more representative of the entire economy. Or let us say BSE 500, where I will include 500 best companies of India. So BSE 500, when I compare with Sensex, which has only 30 companies, obviously 500 companies is a better representation of what the economy is going to perform in future. So these are the different indices which are also there. But as I said, people like you and me are basically going to track mostly, right? Mostly the benchmark index. So if I'm someone who has invested in stock markets, or I have some genuine interest in the stock market, or I may have invested even in mutual funds, I'll always be like that, okay, what is the Sensex? Is the Sensex going up? Is the Sensex going down? What about the Nifty? Is the Nifty going up or down? This is what I will really be doing, because that is giving me a fair idea that in what direction my portfolio is going to move. Will my portfolio outperform the markets? Will my portfolio underperform the markets? This is something that will be decided by, or I would rather say not decided, but this will be something that will be indicated by the different benchmark index. So many a times this benchmark index make even news, isn't it? Especially when the Sensex rises like anything or the Sensex falls like anything, isn't it? So we do have these indices making news, not only on the news channels, but even in our newspapers. Every day, the Sensex and the Nifty and all the other indices will be either moving up or will be coming down, and at times that may remain even flat, but that is normally very unusual. Either it will be going up or down. For example, let's put it in this way. Let's say we are watching the news, and there is a news that Sensex is down by 300 points, or let us say the Sensex is up by 600 points. I'm sure as a student of commerce, if you have tracked the markets, this is something that you must have definitely heard. But have you ever wondered how are they calculating it? How can I say that the market is down by 300 points? How is this calculation been done? How has it been done that the markets have risen by so and so points? How is this actually calculated? Of course, it is the software of BSC, the software of NSC, which is doing this calculation. But as a layperson, I want to have a little bit of idea that how does this calculation be done? So let me give you a brief background that how the calculation is being done. Now, if you are a student of commerce, I'm sure in statistics, you must have learned about index numbers. In statistics, index number. You remember index number? What happens over there is we select one base year, and for base year, you will set the index to be 100. And then you will calculate index for different years. So for year 1, 2, 3, right, I'll be calculating the index. This SENSEX, this NIFTY, they are ultimately nothing but a series of index numbers. So it is actually statistics at work in real life, right? So what we statistically learn as index numbers, that's the same concept that we are applying over here. There is a certain mechanism, a formula, you may say, an algorithm, which is actually running in the background of that software, and it is constantly generating a series of index numbers. Now, to make things simple, let's put it in this way. Let us try to understand this with the help of an example. What we are really calculating is a price weighted index. Okay, so what I want to do is I want to explain this to you through a price weighted index. Okay, now what does the stock markets do? I'm just explaining in very brief, in a very simple manner actually. So what we are doing is we take index of previous day, okay, and we multiply this by MCAP will stand for market capitalization. We say market capitalization of current day. This I divide by market capitalization of previous day. This is how I'll get the index for a particular day. Let's put it in this way. I consider the market capitalization and I consider the index. Let's put it in this way. On day one, yes, my index will be 100. As I said, just a second, I'll just check. So we are generating an index number in that we are considering, instead of day one, let me put it as day zero, right? I consider this as the starting point. If you are generating an index number, then the starting point will be 100. So I say index is 100. And let us say the market capitalization is 2000. What is market capitalization? Total number of shares issued by a company multiplied by its market price per share. That is what we will consider as the market capitalization. So let us say a company has issued 1 lakh shares and right now its market price is, let us say, 300 rupees. Then 1 lakh into 300. That is the market capitalization of that particular company. If you are tracking a SENSEX, then we have to do this for 30 companies. So visualize 30 companies, right? We are making a list of 30 companies. We are making a list of the number of shares issued by each of these companies. And what is the latest market price? After all, it is the market price which will be decided by the forces of demand and supply. Number of shares will not be changing every day, right? Number of shares issued will remain more or less the same unless and until some company is planning a new issue of shares or planning a buyback of shares or planning a rights issue or a bonus issue. Unless and until such corporate action is not there, the number of shares issued by the company will remain the same. So visualize 30 companies in a SENSEX, visualize number of shares, and that we are multiplying by its market price. That is giving me the market capitalization of every company. And now take a total. Let us assume for a moment that the total market capitalization is turning out to be 2000. Now, the next day, Okay, what happens the next day is number of shares is remaining the same. But because of forces of demand and supply, the market price will change. So number of shares multiplied by the new MPS will give me the new market capitalization. Let us say the new market capitalization is 2500. Now, I will use this formula. I now want to know what is the index number for the next day. So index of the previous day will be considered, which is 100. Then market capitalization of the, the market capitalization of the, just a second, I'll just remove it. Market capitalization of the current day will be considered, which is 2500, and this will be divided by the market capitalization of the previous day, which is 2000. Okay, I have a calculator with me, so 100 into 2500, I'm dividing that by 2000. My new index number is 125. So you know what I will say? I will say that the market is up by 25 points, right? I will say the market is up by 25 points. So when you say Sensex is up by 300 points, Nifty is down by, let us say, 150 points, this is the kind of tracking that we are doing. Okay, we are taking a very simple example, but this has been done constantly by the underlying software that has been used. The underlying software is constantly calculating the current market price. It is constantly calculating what is the current market capitalization. So at a given point of time, it constantly generates an index number series, right? Continuing with our example, of course, our example is highly simplified, but this will help you understand the entire concept. That's the intention. Let us say on the next day, let us say the supply is more than the demand, let's say, and out of those 30 companies, let us say share prices of 20, 25 companies are down. Let us say it goes to 2250 the next day, 2250. So you know what will happen the next day? The next day, I will take the previous day's index, which was 125. I will multiply now with the new one, 2250, and I will divide this, let us say, by 2500, isn't it? Which is nothing but the previous day's market capitalization. So 125, I multiply by 2250, I divide by 2500. I am getting, let us say, yes, I am getting 112.5. Let me compare this with 125. So you know what I will say? I will say that the market is down by 12.5 points. Okay, the market is down by 12.5 points. So I have generated a new index number. I'm comparing that with the previous day's index number. And that is how I'm communicating to the whole world now that, see, this is the movement in the index. This has been done every day on the stock markets. As I was saying, again, I'm repeating the same thing. You are constantly, continuously generating an index number series. You know, the software that is used by the stock exchanges, they are updating the share price every 15 seconds. Every 15 seconds, the market price will get updated. And every 15 seconds, even the index number will also get updated. Right? Now, one thing. Let us now try to reach slightly closer to what is done in the real world. Okay, what is done in the real world? Slightly closer to that. We are saying market capitalization, but actually in India, whether it is NSE or whether it is BSE, we use what is known as free float market capitalization. Okay, instead of total market capitalization, we are using free float market capitalization. I did not discuss this earlier because I did not want to complicate the entire concept. But now let us understand what happens in the real world. Formula is the same. index of the previous day multiplied by the free float market capitalization of current day divided by free float market capitalization of the previous day, right? What is this free float market capitalization? Okay, so what was the concept of market capitalization? Total number of shares issued by the company multiplied by then existing market price per share. That's what I call as the market capitalization. So in market capitalization, I consider total number of shares issued. But in the real world, we do not consider total number of shares. We consider only those shares which are freely tradable. Okay. We consider those shares which are freely tradable. For example, a company has issued 1 lakh shares, but out of that 1 lakh shares, 20% shares are owned by the promoters. Now, promoter will not buy and sell share of his or her own company every day. This is not going to happen. So promoter will not be trading in its shares. So instead of 1 lakh shares, I should consider only 80,000 shares, right? Promoter's holding is 20%, but those shares are not freely tradable. And that is the reason only 80% shares are freely tradable. After all, it is the general public which is constantly buying and selling shares. So whichever shares are available for trading to the general public, I should consider only those shares. And that is the reason I will consider the free float market capitalization. See, a promoter cannot buy and sell share. A promoter has information which you and me as a part of the general public does not have. For example, a company is supposed to announce its quarterly results. Don't you feel that the promoter will be knowing the quarterly result much before than us, isn't it? So the promoter knows that, let us say a promoter knows that once this announcement is made, its share price might rise on the stock market. For example, let us say constantly since last 3 quarters, the company was reporting a loss, or let us say the company was reporting a small amount of profit. In the current quarter, the company has booked huge amount of profit, but still an official announcement has not been made. But this information obviously is available to the promoters. This information obviously is available to the managers of the company. They know from the very beginning that when we will make an announcement and the moment we will announce that we have booked a huge amount of profit, the share price on the stock market will rise. Right? So this is something that they already know. So it's quite possible that they may use this information and they may quietly start buying shares from the stock market before the official announcement. Because right now this information is not there in the market. Since last 3 quarters, you were booking a small amount of profit or maybe even a loss. So there is not much demand for your shares. And hence the share price is on a lower side. So as a promoter, you are quietly buying shares from the stock market at a lower price. Then you announce the results. The share price now starts rising. The share that you purchased at a lower price, you are now selling that same share back to the public at a higher price. This is what is known as insider trading. Okay, right? We call this as insider trading. Insider trading is detrimental to the public at large, and hence it is banned. Right? So no one can do insider trading, not just in India, actually worldwide. That's the reason we are using the concept of free float market capitalization. As a promoter, I cannot buy and sell shares on daily basis. So please exclude those shares. Which are the shares which are publicly tradable? Consider that, work out the free float market capitalization, and on the basis of that, decide what is the index, or rather the free float market capitalization, and then decide what is the index for a particular day, right?
Press the bell icon on the YouTube app and never miss another update.